It is Wednesday. That is correct. So Wednesday is 10:30 a.m. Eastern Time. We take a look at those crude setups ahead of the EIA inventory report for crude. Crude's had some volatility as well with these markets recently, climbing, almost trying to make it up to that $70 price level. Pretty remarkable. So it's 10:21 right now. Those numbers get released every Wednesday, 10:30 a.m. Eastern Time. Let's jump over to the NADEX platform, check out this oil market. So I have the chart up here. We're looking at the June futures contract. We're currently trading 67.84, and let's jump into the crude oil spreads here. So we like to take a look at the volatility trade, purchasing, buying a bullish spread, selling a bearish spread, and then having profitability in either direction, hoping for a dramatic move when we get those numbers about 8 minutes from right now. So I started things off, Tom. We're trading 67.83. I took a look at the ones that expired 11 a.m., which would be the shortest time frame. And those don't really line up too well with the price point right next to where we're trading. You'd either have to choose 67.50, so you'd be about 30 cents away to the downside, or 68.25, so it's kind of right in the middle. So I jumped right to the noons, and that's where they line up pretty well. I say pretty well as this moves. We're almost to the penny. So you'd have a 67.75 spread that goes up $1.50 to 69.25, and then you'd have a 67.75 spread going down $1.50 to 66.25. So I have those two spreads up here already. Here would be your bullish spread, $1.50 up from where we're trading at right now. Pretty much, we're within a penny or two from 67.75. So you'd be buying this spread, and that's going to cost you about $26. Now, most of this, I say most, all of it is just premium, right? Because we're kind of below by a penny where this spread begins. And then, similarly, you would be selling the bearish spread, and that's going to be a little bit more money only because you have about a penny and a half of intrinsic value in the bearish spread currently. So you're looking at, you add those two together, you're looking at about $54, call it, of cost for both spreads. So you would need 54 cents of movement away from 67.75 to begin your break even. And those expire at noon, right? So you'd have about an hour and a half after we get the inventory numbers at 10:30. Looking for just more than about 50 cents of movement from where we're trading at right now before you begin to break even. Now, just out of curiosity, let's jump into the 230s. I haven't even checked them yet, see where they line up. So a little bit different. 67.50 would be our point that we could use here. And what happens there is that you're going to have almost 30 cents of intrinsic value to the bullish side, right? So that's going to kind of take on a bullish bias there.
What was that number again, Tom?
For the 230s?
Yes.
67.50.
Thank you. Okay.
So that's where, you know, we're trading right now at 67.80. So just to put it up and go through it real quick, here would be your bullish spread. Now it's $3 instead of $1.50, but it's going to cost you $50 just for this one contract because 30 cents of that is actual value, let alone the premium that you're going to have to pay for that basically spread. And then on the downside, you'd have no value and just premium. So that's going to cost you $68 as opposed to about $54, $56. But what changes here is that it has a bullish bias because you have this 32-cent head start to the upside. So if you were to break even to the downside, you would need 68 cents of movement below 67.50 to the downside before you started to break even. So you can see that it changes kind of the dynamic of that trade when you're so far in the money on one side. That's why if you just want to trade pure volatility, it's nice when they line up right next to where the floor and the ceiling begin, which for these noon trades, 67.75 is where your bullish spread begins, up to 69.25, and then 67.75 is where your bearish spread begins, down to 66.25. And as these tick around, now you're going to have value on the bullish side, so that's going to turn into your expensive one, and there's your bearish one. Same price, but they're kind of, wherever that value is, that's where it's kind of swinging left and right. So again, be about 54.
And you know what's so cool? Like, just from the trading of today in the futures market, we've had movement of 67 cents from the highs to the lows. You know, the high today is 67.99, the low is 67.32.
Okay, so, nice. Nice. And, I mean, look at the action that we had, right? Just call it, I mean, Monday and Tuesday, let alone the past recent weeks of the action we've had. So we'll see. We've had some surprising numbers in recent weeks as we've seen surprises in the actual inventory number that's come out. And it's always nice when you're trading volatility when you get an actual surprise in the underlying fundamentals, which is really what you hope for, of course. But sometimes we've seen it where they come right in line and the market still reacts pretty violently one way or the other. So we'll see where that sets up. It's kind of nice to compare the options you have in terms of whether you want to look at the 11s, the noons, the 230s, what kind of price action you have, and that all depends on what your market bias is. Do you want to pay that extra premium? Do you want to pay for maybe you have a little bit of a bullish bias and you'd actually prefer that 230 trade, right, where you have exposure to the downside, but it's kind of a bullish bias where you can kind of break even much easier with an upward movement when you already have that 30-cent head start. You know, just to put it, this would be your bullish spread. So we went over it, it'd be about $68 for both contracts. So your break even from 67.50 would be 68.14 on that 230. But again, the one that I kind of liked, if you're looking for straight volatility, was that noon trade.
That noon.
$54 for both sides. And we'll see. We'll come right back. It's 10:27 right now. We get those numbers in 3 minutes. Come on back, folks. We'll see where that oil market shakes out. Welcome back, folks. Tom and Tommy O'Brien. So I see those numbers, Tom. You got them up. We got a surprise in the market a little bit. We have crude oil inventories rising 2.17 million barrels. And as I was looking for those numbers, I saw that Bloomberg users were feeling a teensy bit bullish this week with an estimated 114,000 barrel overall crude stockpile draw. So,
wow.
So 114,000 barrel draw, call it almost even, right? That's only 100,000 barrels. But man, 2.17 million barrels rise. And as we see that, let's jump over because, man, that market, I had it up, and let's see, it was. So it spiked within the span of about 15 seconds, not even 15 seconds. As the news broke, it traded from 67.80 right down to 67.40. So 40 cents in the span of 3 seconds, and it's kind of hanging out at that level now. Now, to recap, we were looking at the noon trade potentially, 67.75. Man, look at that market as we speak. 67.75 would have been our pivot point where we had profit. We had exposure in either direction from that point. We had value in either direction. And so pulling up, this would be our bearish spread, which would have most of the value at this stage. And right now, you're looking at about $41 of potential value as this is trading at 67.36. And as it keeps ticking, we're at about $40 because your 40 is 67.75 down to this 67.34, which is the active offer that you could buy it at. And, yeah, you know, our trade was going to cost us $54, so we're not quite at break even yet. But keeping in mind, we're now 2 minutes past the news, and these are noon expiration spreads. So you have your choices here. You know, if you're bearish, you could let this run. If maybe you think that's not too surprising and the market could turn around, you could always close out this spread like we speak of. You take off some value of that spread, whether it's $30 to $40, cutting your only investment basically down to $10 or $20, right? And then the bullish spread remains active. If you rise above 67.75 before noon, you start getting value to the positive side. But it's good to see when you make a volatility spread trade that the market moves 40 cents in 3 seconds following those numbers.
And you know, it's amazing. You can see, like, on the Bloomberg right now, we get all those numbers. Look at that. The Bloomberg were just, you know, their analysts were down a little, but look at the medium estimate was minus 2.2 million drawdown, and we got a plus 2.1.
It always is intriguing. So they have the Bloomberg user survey, that's market-wise too. You know, you have a lot of big investors. That's a big terminal. But median analyst estimate, man, that's pretty remarkable, was expecting a 2.2 million barrel decline. It comes in at 2.2 million barrels, but guess what? Of a rise, not a decline. So a miss of about 4.4 million barrels, and that is the reason for that big 40-cent spike right to the downside. And, you know, surprises in gas that we're seeing as well. Gas inventories rising 840,000 barrels as well. Surprise. I see surprise all over, the word surprise all over that feed.
Seriously, man.
Yeah.
Seriously.
So
I'm glad we got, you know, lots of gasoline, because the bottom line is that we're driving season starting, 30 days.
I filled up my gas tank this morning, man. I couldn't help look at that price and say, man, oil, what's going on? Why is it near $70? We need a little reprieve, and maybe this will get it. So checking back right now, 67.48 currently. We're about 4 minutes past the news. We'll check back in on the hour, see where we go. Okay.
So look at that. You know, for a gain they're not really hurting that oil market. That's interesting, right? I mean, that's,
Yeah,
you know,
I mean, that's
yeah.
as we see it. It takes a while to digest everything in this news. You know, the first move is always very quick off of the top line number, which is, you know, the decline of 2.2. I'm sorry, the rise of 2.2 versus the decline estimated. But man, they have demand in here. They have, you know, so many numbers that's why the noon sometimes works out exposure to the noon spread, because we see that the price action can take 15 minutes. And as we speak, now we're at 67.33. We're almost at the low, and maybe that's where the market's digesting, making sure before they sell it off that there's nothing in there to hint at, you know, a possible rise in demand that might take care of that surplus, because we're almost at the lows that we've made as we're at 67.33 as we speak.
Gotta love it.
Pretty cool. Totally.
Pretty amazing.
Yeah. Welcome back, folks. Tom and Tommy O'Brien. So, Tom, I want to check back in on that oil market if we can. We're getting a little bit of a slide to the downside. So it's currently 1042, and we're at 67.16 now, getting a little bit of another leg down.
We're in the money.
We are in the money. That's right. So if you had made that trade, again, we're looking at about 54 cents. And right now, we're give or take. We were, and that's how quick this market's moving. But right now, you could buy back your bearish spread, the one going from 67.75 down to 66.25. For about $50 you'd receive there, and that would cover all but about $4 of your trade for both sides of it. But we'll see. I mean, the day is young, and that these are noon expiration spreads. It's only 10:43 right now. Market's jumping around. And again, that's where you have a lot of options to trade these prior to expiration, depending on what you feel like is going to happen in that market. But good price action to the downside so far in the few minutes following those news, and we'll see where it shakes out. Pretty cool. Welcome back, folks. So it's 10:54. I just want to check back in on this oil trade one more time, because man, oh man, we got some volatility to the upside. We're looking at 5-minute bars here, and we just went from 67.30 all the way up to 67.80, and we're currently sitting at 67.76. So quite a reversal like we talk about. If you had the foresight to close out the bearish spread, that would be a nice trade, because now you'd have the exposure to the upside with over an hour left. But pretty remarkable price action in oil, and we'll see where that leads us until the noon expiration, but pretty cool setup. Just want to check back in on it one more time, Tom, before the hour ended.
You gotta love it.